Hey, finance students, we are looking at Chapter 8, practice problems here, looking at applying the capital asset pricing model, or CAPM for short. Just a reminder, CAPM is just a way to calculate required return or expected return of an asset, more specifically a stock, based on its risk. And beta, as we have seen in this chapter, beta is a study or a measurement of a stock's risk relative to the overall market. So we will use beta in some calculations here in order to calculate the capital asset pricing model, the required return of a stock using the capital asset pricing model. And one of the things that we know after having looked at Chapter 10 is we can use the calculated return that we find here using the capital asset pricing model and plug that into the dividend growth model, where the K is the cost of equity or the required return on a stock, same thing. We can plug that into the dividend growth model from Chapter 10 to calculate the expected price or expected value of a stock. So that is where CAPM comes into play. So we are going to work through a few problems here and calculating the capital asset pricing model, some of the required returns. So we'll start here at the beginning. We're looking to buy some Apple stock using Google Finance, and we need to find the beta for Apple, then find the risk-free rate, the 10-year note, using the U.S. Treasury website, which I give you right here in your practice sheet. Now, once we find that information, we can calculate the required return for Apple stock, assuming a 10% market rate. So first of all, right there, we are given a 10% market rate. So we're going to go ahead and assume that 10% market rate. So the next thing that we want to look is for the risk-free rate, the RFF. And we will find that here at the treasury.gov website. So if we click on that, that should take us here. And we're going to look at our 10-year treasuries as of today. And today is December 14th of 2017. So we're going to go ahead and use this 10-year treasury rate of 2.35%. Rates have been hanging right around here over the last couple of weeks, right around the 2.35, 2.4 mark. And so that's pretty good. So we're going to go ahead and just stick with that. Risk-free rate is 2.35%. The next thing we need to do is find the beta of Apple. So we're going to go to finance.google.com, and we're going to search for Apple, AAPL. And that's going to bring up the current stock price of 172.22. And we want beta. Beta is 1.24. Now remember, the beta of a market is 1. So this says that Apple stock is just a little bit more risky than the market. So it's 1.24. So we can flip back here and we can go to 1.24 for my beta. And once we have that, then we can plug it into our formula, our CAPM formula. Remember, the formula is the return on a stock, J, is equal to the risk-free rate plus beta times the market rate minus the risk-free rate. So once we have that, we can plug it in. So to find a return, R of J or R of S, the return on a stock, return of stock J, is the risk-free rate, 2.4%, plus beta times, and then we need our parentheses here, the market return minus the risk-free rate. Once we have that, we'll close our parentheses, hit enter. So that shows an approximate return on Apple of about 11.8%. So that's how we use the CAPM pricing model. Let's do another one. Two stocks, A and B, have coefficients of 0.8 and 1.4 respectively. So one is a little bit less risky than the market. The other one is a little bit more risky than the market. If the expected return on the market is 10%, the risk-free rate is 5%. What is the risk premium associated with each stock? What is the required return for each investment? So we can plug these in. So we have stock A and B. Stock A's beta is 0.8, and stock B's beta is 1.4. So we're going to enter that there. We are given the market rate. The return on the market is 10%. So we can plug that in here. We can also plug that in here. We know the risk-free rate is 5%. That's given to us. So we can plug that in and plug that in here. So we know the risk premium. The risk premium is this part right here of the formula. That's the RM minus the RF. So that part of the capital asset pricing model formula is considered the risk premium. It is the percentage above a risk-free investment that investors are requiring in terms of their investment. So in order to calculate that, we're just taking our market return minus our risk-free return. So on both of these, we're going to have the exact same risk premium because it's based on the same numbers. Now, in order to find the required return, now that we have calculated the RM minus the RF, we just find the return by calculating the risk-free rate plus the beta times that. So our risk-free rate plus the beta times our risk premium. That's all we have to do once we've calculated the risk premium. So the required return on stock A is 9%. And if I do it right, well, we'll do it again over here. We have our risk-free rate plus beta times our risk premium. And that one would be 12%, which would make sense. This one has a little bit higher level of risk, and therefore it requires a little bit higher return that we see. Okay, let's scroll down and look at the last one here. We're looking at portfolio beta. Okay, so how do we calculate portfolio beta? And it's very simple. Portfolio beta is simply a weighted average of the existing betas within the portfolio, the stock betas within the portfolio. So you've got a portfolio, has 3 investments. A is 50% of the portfolio and has a beta of 1.2. B makes up 25% of the portfolio, has a beta of 0.7. Investment C makes up the remainder of the portfolio, has a beta of 2.25. What is the beta for the entire portfolio? So we just need to go through and fill this in, and we'll take a weighted average of each of those. So investment A beta is 1.2, and it's 50% of the portfolio. Investment B has a beta of 0.7, and it is made up of 25%, and investment C has a beta of 0.25, and it also makes up 25% of the portfolio. So in order to calculate our overall portfolio beta, we're just going to take a weighted average, which is simply the beta times the weight of each of these investments. The beta times the weight plus the weight, beta times the weight plus the beta times the weight. That will give us our overall portfolio beta. So to do that, we take our investment A beta times 50% plus investment B beta times 25% plus investment C beta times 25%. It's that easy. And so that gives us an overall portfolio beta of about 0.84.